Hey, good morning, everyone. Marty Mazzori here. About a half hour before the open, this will be your pre-market update today, and I'm going to work really hard to keep it quick. I'm going to try not to get too deep into the weeds of the news and the fundamentals. I tend to do that during the morning on the written blog as catch up on the data and the news and the things that I think are moving markets and so on. But here you have that S&P 500 future chart that we've been working on in the mornings. Again, I pointed to this decline. My expectation was we'd come back, find some resistance, which we've clearly found here. We identified yesterday that we have hit it 4, 5, 6 times. Yesterday morning, like today, we were rallying. I said, looks like we're going to hit that again, may blow through it. Didn't. Had a pretty good down day yesterday. This engulfing candle right here, this green candle is engulfing all of the red right now. And that's very bullish, quite frankly. If that continues, looks like this may be the day that we go up through here. Make no mistake, there is a large quantity of shorts right in here. Folks who have been doing battle with the bulls right on this line. Remember, shorts are folks who have borrowed securities, sold them, expecting to buy them back at lower levels and pocketing the difference. Market runs away from them. They can get creamed. So they have their buy stops. They actually have to buy to close. You get up in here with some momentum. You need to change to an arrow there. You get up in here with some momentum. Those folks cover, and you get this exacerbated move higher. Now, that has nothing to do with fundamentals. That just has to do with positioning. And it doesn't mean that the shorts have are going away for good. It probably just means they come right back up in here and redo this battle at relying at these all-time highs. As I've made very clear, folks, I would not take anything up here as a sign that we're off to the races and we're going to sustainably move to new all-time highs. I do think there's a good chance we bust through here and we threaten these levels. But without a better look in the underlying fundamentals, I think all of this should be faded by traders, in my view. Remember, we do have a prevailing bias that looks pretty decent. Target and Lowe's had good earnings this morning. Market's really rallying on that news. Consumer sentiment's coming down a bit. Remember, the earnings are yesterday's news, but they actually have a pretty good outlook. Underneath that, we have an underlying trend that is waning. There's no question. Our index is negative by 10 points. We haven't seen that since we started the index. We've seen that in backtest, but not on a real-time basis. We had an inversion of the yield curve last week. Germany just issued a 30-year bond at a 0 interest rate. I will tell you this, folks, I am still working to get my head around what it means when a third of the tradable bonds, including corporate bonds in the world, are trading at a negative yield. There's ultimately going to be an unwinding of that, and I can tell you this unequivocally, it ain't going to be pretty, and it's going to have broader implications for the global economy. I've also mentioned that there's a raft of BBB corporate debt that if and when it gets downgraded, a lot of it during the next recession, that's going to be some strain on the credit markets that aren't going to feel good. So again, I promised I wouldn't get too deep in those weeds, so I'll stop right there. Now taking a look at the S&P 500 itself, this is what's going to open here shortly, much higher than it is right here. Clearly, right in here, we have established a key. It's pretty wide, but it would be a consolidation area. You can see very clear tops right in here. The bottom is right here. So clearly this is not that, that three-wave down, up, down that I originally anticipated. Now there's an old saying, and it's been my experience that it's true, the longer we go sideways, the bigger the breakout when we finally break out of that channel. Take a look back in here. This is a bigger one, but this is that big correction that we had last fall. We got stuck in something that kind of looks like this, only it's just wider and longer, and then we had that big decline, worst December in 100 years or so. And so here we are now, and again, as I've said, I think that I think it's 50-50 that we break out above or below. Could very well break out of that today. We sure have some momentum, and it's basically just aggressive talk about stimulus coming from all directions, both monetary and fiscal. And make no mistake, and the powers that be are desperate to avert a big decline. Something is indeed going on under the surface. Then we have to ask ourselves, does lower interest rates right here really do anything? Will it do anything other than push asset prices up? The answer right now for me is unequivocally no. Not that the wealth effect doesn't mean anything, but in this environment with all the geopolitical uncertainty, it's not going to spawn a great deal of activity. but it could very likely push asset prices higher, which makes it very dangerous if and when they resolve lower. Just go back to my written blog yesterday where I show you what typically happens. Our index back-tested rolls over, the market rallies, and then the recession and the big bear market comes. Happened during the tech bubble. Then we got to the real estate or mortgage bubble. Our index rolled over, market rally. Then we had the worst recession and bear market since the Great Depression. Well, folks, our index just rolled over and the market is rallying. I don't know what's going to happen next. I just don't. I do know this. What's going on right now is all fueled by stimulus or the prospects for stimulus. Nothing fundamental to get excited about whatsoever. But throw the stimulus in and an ending of the trade war, and maybe we have a false signal. Maybe we don't have to live through this. But if it's not a false signal, if indeed this is going to be the outcome, underneath this we've got something like 17 trillion of negative yielding debt that needs to be figured out. And we have, a massive amount of bottom quality investment grade bonds that get downgraded, and we've got a mess there. So I think this next recession, whether it comes this year, next year, the further out the better, but if it comes in the next year or two, there are conditions underneath that are going to have to be resolved, and they need to be resolved, and the recession will do it. But as they get resolved, I think it gets ugly. I think it could very well look a lot like a 2008 in terms of the depth of the asset price decline. So right now, under the circumstances, with the stresses we're seeing, with what happens under the surface if something breaks, in the current geopolitical environment, until it gets a lot better, on behalf of our clients, we are going to play defense. We're not rushing to cash right now. We're just hedging using options to buy us some time, let the situation play itself out. If we miss out on some upside, so be it, because again, if something breaks below, it could be precipitous and it could be the kind of decline that takes years to come back from. I'll leave it there. Thank you, folks, as always, for watching and listening, and I'll be back very soon. Take care.